Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, there is definitely a lot to unpack today, especially with the recent data.
Right, if you look back at the summer of 2026, everyone was basically obsessing over AI, right? Like microchips, high-flying tech stocks, the usual headlines.
Absolutely. It was inescapable.
But according to some recent analysis, one of the quietest, most lucrative trades in the entire market was actually happening in, well, literal garbage sitting at the end of your driveway.
Yeah, it sounds like a joke, but it's really not. I mean, we're in this market environment right now under the current Trump administration where capital allocators are operating in a very specific, hypersensitive way.
Sensitive to inflation, mostly.
Exactly. Sticky inflation, the trajectory of interest rates, the whole macroeconomic backdrop. Investors are constantly trying to price in the cost of capital.
Right, which makes sense. Whether you're a beginner just trying to figure out how to protect your money or you're deep in the weeds, this is highly relevant. Because the companies picking up our trash have been moving in almost perfect opposition to the hottest AI assets out there.
It really is a masterclass in portfolio strategy. I mean, when you put high growth, capital intensive tech assets right next to everyday physical services, you see exactly how institutional money moves when future growth looks even a little bit uncertain.
Okay, let's unpack this because the data on this rotation it's incredibly distinct.
It really is.
According to this analysis from Bloomberg Intelligence's Eric Balchunas, throughout 2026, the Round Hill Memory ETF, the ticker is DRAM, D-R-A-M, experienced massive volatility.
Right, and that ETF is essentially a proxy for AI infrastructure, memory chip manufacturing, that sort of thing.
Exactly. Highly sensitive to supply chain news. But meanwhile, waste management companies, specifically giants like Waste Management, ticker WM, and Republic Services, RSG, they showed a very strong negative correlation to that tech ETF.
Yeah, and the mechanics of that negative correlation are just fascinating. Like if you look at July 30th, the data shows the DRAM ETF jumped roughly 13% in a single trading session.
Which is a huge day.
Massive. But on that exact same day, waste management dropped about 4%. And, the inverse happens when tech takes a beating.
Wait, so the trash stocks actually catch the money fleeing from tech?
Pretty much, yeah. When hedge funds decide to de-risk because, say, some semiconductor earnings call sounded a little pessimistic, they don't just go straight to cash. They rotate into assets with absolute predictability.
That is wild. So for you listening, a helpful way to visualize this rotation is, well, think about the assets themselves. Investing in AI right now is kind of like betting on a futuristic, experimental sports car.
That's a great way to put it.
Right. Like the potential speed is thrilling, but it relies on all these future promises, that the tech scales, that consumers actually adopt it, that the road ahead is smooth.
Yeah, whereas investing in waste management is, well, it's like owning the paved road itself.
Exactly. Zero glamour. But everyone, including the guy building the fancy sports car, has to pay a toll to use that road every single day.
What's fascinating here is how the market actually values those two very different industries. It comes down to the discount rate applied to their cash flows.
Okay, keep it simple for us. What does that mean in practice?
So when you buy into AI or big tech, those valuations are heavily based on future growth, right? And massive capital expenditures or CapEx.
Right, they have to spend billions now to maybe make money later.
Exactly. And because the bulk of their projected cash flow is expected years, maybe decades in the future, those stocks are incredibly vulnerable to interest rates. If rates stay elevated, the present value of those future earnings it compresses instantly.
So the market basically recalculates the cost of waiting 10 years for a profit and decides the stock is worth less today.
You nailed it. But waste management businesses, they operate on a completely different timeline. They are anchored in essential, daily, physical cash flow.
Because, as long as humans exist, we make garbage.
Right. Grocery consumption, packaging, industrial scrap, these things are constants. Waste management's revenue isn't going to suddenly drop 50% in one quarter just because some software trend shifted,
Right, their financial baseline is physical reality. But wait, let me play devil's advocate here.
Go for it.
Why are Waste Management and Republic Services so special? Like, couldn't someone just get a commercial loan, buy a few dump trucks, undercut the local prices by $5 and steal all their customers?
See, that's what a lot of novice investors assume. They think, oh, it's just picking up trash. It's a low-barrier industry.
It's not.
Not at all. The truck is just the transportation mechanism. The true power, the actual economic moat, isn't picking up the trash, it's the destination.
You mean the landfills?
Exactly.
Yeah.
It's owning the landfills, the transfer stations, and holding the local municipal permits. Building a new landfill is a labyrinth of regulatory exhaustion.
I can imagine. No one wants a dump in their neighborhood.
Right, the classic NMBY, not in my backyard sentiment. You have to fight local zoning boards, get EPA environmental clearances, do geologic testing, and it can take upwards of a decade just to get a new landfill approved.
Wow. 10 years.
Yeah, and that's if local politicians don't block it first, which they usually do. So the existing landfills become these extraordinarily valuable assets. In many areas, WM and RSG are basically functional monopolies simply because competing is legally impossible.
That makes total sense.
Yeah.
And looking at the Q2 2026 earnings, based on the research, we can see exactly how lucrative that mode is.
The numbers are pretty staggering.
Yeah, Waste Management pulled in $6.684 billion in revenue for the quarter. That's up 4% year over year. And they generated $1.1 billion in free cash flow. Republic Services hit $1.42 billion in adjusted EBITDA.
But here's the craziest part of that data. Did you see the volume metrics?
Yes, I was just about to bring that up. The actual amount of trash they collected went down.
Right. RSG's volume dropped 1.6%, and Waste Management saw a 1.8% decline.
So they collected less garbage but made more money. How does that even work?
That is the ultimate proof of pricing power. Because they hold those regional monopolies we just talked about, local governments really don't have alternative options.
So they just jacked up the prices.
Essentially, yeah. To combat the sticky inflation in the broader economy, they implemented core price increases of over 5%. Plus, a lot of their long-term municipal contracts have built-in CPI escalators.
Ah, so if inflation runs hot, their prices automatically go up legally.
Exactly. And they actually manage their customer base with a price over volume strategy. They will intentionally let go of low-margin accounts.
Wait, they fire their own customers?
Yeah. If an account isn't profitable, they drop it. That drives down the total volume of trash, which means fewer trucks running, less fuel, less labor. But the higher prices on the remaining accounts push their overall profit margins way up.
That is genius. I know Republic Services CEO called the industry recession resilient rather than recession proof.
Which is a very important distinction. During a real economic downturn, commercial trash does dip. Retailers sell less, construction stalls, but their ability to push prices and cut costs protects their profits even when demand softens.
Okay, here's where it gets really interesting, though. It is so tempting to think of these trash companies as like anti-technology dinosaurs, just diesel trucks and dirty landfills.
Right, but the data paints a completely different picture.
Exactly. According to the documents, WM and RSG are pouring massive amounts of capital into AI, sensors, automation, and robotics.
Yeah, and we're not talking about generative AI writing emails for them. This is heavy industrial machine learning.
Right. Between 2022 and 2026, Waste Management invested huge capital into automating their recycling facilities. And the data shows this led to a 32.5% jump in their recycling and renewable energy EBITDA in Q2 of 2026 alone.
The mechanics inside those facilities are incredible. It used to be all manual labor people standing at conveyor belts sorting plastic and paper.
Sounds awful, honestly.
It was tough work. But today, they use near-infrared optical sorters guided by machine learning. These sensors can tell the difference between a water bottle and a laundry detergent jug moving hundreds of feet per minute.
And then robots just pluck it off the line?
Yeah, robotic arms with targeted air jets remove the materials with near-perfect accuracy. It slashes labor costs and increases the purity of the recycled materials they sell, which means they can charge a premium.
Oh, and the renewable energy part, too. They capture methane gas from the decomposing garbage in the landfills, process it, and sell it as renewable natural gas.
Which is essentially turning a massive environmental liability into a highly profitable energy commodity.
It's brilliant. So they're the ultimate beneficiaries of AI.
They really are. But here is the key difference. Their survival doesn't depend on AI meeting global expectations.
Right. If the whole AI trend just fizzles out or slows down, WM's core business is perfectly fine. We still need our trash picked up on Tuesday.
Exactly. They get the upside of the tech revolution, better margins, lower costs, without the existential risk of relying on, say, NVIDIA GPU sales to make their quarterly numbers.
Okay, so what does this all mean for the listener? Should you just sell all your tech stocks right now, buy WM and RSG, and treat them as an automatic safety net against an AI crash.
Okay, I have to issue a strong warning there. These stocks are not some magical inverse ETF.
They don't just automatically go up when tech goes down.
No, not in a real crisis.
Yeah.
In a 2008 style or 2020 style systemic financial panic, people sell everything. Institutional capital liquidates across the board to raise cash.
So trash stocks will fall too.
Absolutely. They reduce the relative drop of your portfolio, they act as a shock absorber, but they do not guarantee absolute profit during a total macro crash.
And looking at the data, they also carry a ton of debt, right? Because they're so capital intensive.
Yes. By mid-2026, Waste Management had roughly $22.3 billion in long-term debt. Republic Services had about $13.5 billion.
Wow. So if the AI bubble pops strictly because inflation spikes and the Fed holds interest rates higher for longer,
Then these waste management stocks could suffer heavily too. Servicing tens of billions in debt with high borrowing costs eats directly into that free cash flow we were praising earlier.
and I imagine they aren't exactly cheap to buy right now either.
Not at all. Because they are known as these safe haven defensive assets, a lot of capital has already crowded into them. They're trading at very expensive premium valuations right now.
So rotating out of an overvalued tech stock just to buy an overvalued trash stock might limit your returns anyway.
Precisely. Which brings us to the real takeaway about diversification. True diversification isn't just owning 50 different software and semiconductor stocks.
Because if tech crashes, they all crash together.
Right. True diversification means separating the actual sources of your cash flow. You pair AI, which is driven by digital growth and future expectations, with waste management, which is driven by physical reality, local contracts, and pricing power.
You're protecting yourself because the two industries make money for completely different reasons.
Exactly. A shift in one economic variable might hurt one, but it won't dismantle the fundamental business model of the other.
That is such a crucial lesson. It really makes you think. We spend so much time obsessing over the digital cloud, virtual reality, the speed of microchips.
We really do.
But if the ultimate financial anchor in a high-tech world turns out to be the local garbage dump, well, what other boring, invisible physical utilities in our daily lives are we completely ignoring as massive economic engines? Think about the water pipes under our streets or the concrete in the highways. The stuff we ignore every single day might actually be the most entrenched engines in the market.
It's definitely something every investor should be looking into.
Absolutely. Don't forget to subscribe and hit that like button.